This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to Value Investing Podcast. This is episode 36. In the last episode, we talked about Philip Fisher in terms of how he buys stocks, and he has 15 rules to go over before making that buying decision. In the last episode, we haven't got a chance to talk about all those 15 rules. So what I'm going to do here is that I'm going to just cover the remaining points that we haven't got a chance to talk about in the last episode. The reason why I mention and talk about Philip Fisher's investment rules is because Philip Fisher is actually not a value investor. He's categorized as growth investor. But the first time that I came across his name was from Warren Buffett, because Warren Buffett said that Warren Buffett is 85% Ben Graham and 15% Philip Fisher. So I wanted to know why he said so and why he put a lot of emphasis on his investment principles and how he got influenced by Philip Fisher. So Philip Fisher is a long-term investor, as I mentioned in the previous episode, and also is a growth investor. And he has had very concentrated portfolio, and one famous stock that he has held for his lifetime, more than 50 years, is Motorola. So he's not definitely a short-term investor or trader, and he buys outstanding companies with compelling growth aspects. Since we talked about 8 points when it comes to buying a stock from Philip Fisher last episode, I'm going to just finish up the remaining 7 points written in his book, Common Stocks and Uncommon Profits. And I'm going to include the link in the show notes so that if you want to buy from Amazon, you can just go there and buy. I definitely recommend this book, especially the chapter that's talking about these 15 points. I really think that you will learn quite a lot from going over these 15 points. Philip Fisher is also the person who kind of created this term, scuttlebutt. And this is used by a lot of investors. And when you do this scuttlebutt approach, what it means is that you talk to people in person, whether it's customers, management team, suppliers, competitors, and try to understand and gather information related to the company that you're interested in investing your money in. This is the scuttlebutt approach that Philip Fisher created. And also, Peter Lynch is another value investor who followed in footsteps in terms of doing this scuttlebutt approach, and Peter Lynch made a lot of money from that approach. Anyway, so enough about Philip Fisher, and he's a quite important person when you're trying to understand Warren Buffett and how he became successful. So before we get started, let me give you a quick disclaimer that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further delay, why don't we get started? So we covered, as I mentioned, 8 points last time. So let's go to the 9th point and see what Philip Fisher has to say about finding good companies. The question that Philip Fisher asks is, does the company have depth to its management? Small corporations can do extremely well and provide a magnificent investment for a number of years under really able one-man management. However, all humans are finite. You have to ask to yourself, what if the key man is no longer available? So here, Philip Fisher is saying that the company has to have some deep bench in terms of supplying good management, because one person can run the show if the company is small enough. But if you want to have long-term investment, capital appreciation potential, then the company has to have good management team. If there's a startup and startup is trying to grow, and startup can grow quite significantly at very, very fast pace, but one person cannot manage every single thing in the startup environment as the company grows. So there's going to be some inflection point along the way, and sooner or later, a company will realize that it reached a size where it's just not possible to have one-man show. So it is important to delegate authority to other management teams who should be also capable of doing their jobs. So those organizations where the top boss personally interfere with and try to handle routine day-to-day operating matters seldom turn out to be the most attractive type of investments. And that's what Philip Fisher is trying to emphasize in his book. So what can you do in order to find out if the company has good management team? The thing that you can check indirectly is that I think you can check the tenure of executive team and their experiences. And you can also know who will likely be the successor of the current CEO and try to understand that person. Whether it's she or he, you can go to Google and LinkedIn and see how this successor is going to perform in the future. Of course, you have to focus on the current CEO, and it's likely that success probably is not announced, but you can definitely check the executive team in the company, and it's public information. So you can just do some Google research and LinkedIn, look at their bio, even look at their speeches on YouTube. Maybe they make some speeches to students and get a feel for how they're like. Of course, you have to do this kind of exercise for the current CEO, because I think that that's the most important person in the organization. And also you can do the same thing for CFO, CIO, and so on and so forth. So those are the senior people managing companies' resources. Another thing you can check is senior management turnovers through various articles. For example, there's sometimes a lot of articles about, executive team departures for certain companies. And you can see that from Wall Street Journal and from CNBC. And if there's high executive turnover, it's not really showstopper for your investment decisions, but may have negative impact on your investment. So keep an eye on those high senior executive management team turnovers. The last thing that I would recommend is to look at the proxy document for the executive compensation metrics. And if you go online and look at SEC filings, you'll find proxy documents that lay out in detail how executive teams are getting paid. Financial incentives are very, very powerful tool for executive team to remain within the company. And you also have to check if these financial incentives are in line with shareholders' interests. Okay, so that was a good discussion about whether or not the company has depth to its management. So let's move on to the next point, which is about this question. How good are the company's cost analysis and accounting controls? No company is going to continue to have outstanding success for a long period of time if it cannot break down its overall costs with sufficient accuracy and detail to show the cost of each small step in its operation. So this is Philip Fisher's point, and I don't know how many people really focus on cost analysis, accounting controls, but what you can do to find out whether or not management team is controlling the cost effectively, I think what you can do is you can dial into conference calls and see whether they're talking about their cost trend in detail and what actually was the root cause for cost or expense change. And a lot of management team do that exercise anyway, so why don't you take advantage of that? And another thing that you can focus on is return on invested capital. And I think this is a very important concept because whatever capital is there within the company, it's for shareholders at the end of the day. So you want to know how effectively management is investing this capital into their operation. And you can easily find this financial metric, return on invested capital, from various websites like Morningstar and Group Focus and so on. The last thing that I want to mention here related to this cost analysis is that you also want to find the management who is prudently executing acquisitions for the company. You want to ask this question: do they pay high premiums for the acquisitions? Because usually acquisitions are good for the management team. Because if you look at their executive compensation, then their executive compensations to a certain extent is tied to the size of the company. So if they acquire another company, they can easily double the size of the company within a short period of time, and their pay may rise along with that. But if they paid high premium and if they borrow a lot of money in order to execute the acquisition, then it's going to come back as a negative factor for investors eventually down the road. So you want to be very careful about the management team who's executing this kind of acquisitions for the sake of their own benefit at the expense of shareholders. Let's move on to the next point. And next question that Philip Fisher is asking to find outstanding company is that, are the other aspects of the business somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? So sounds very fancy, but simple question that you have to ask is, does this company have an economic moat and competitive advantages? So by doing this kind of competitive advantage analysis, you'll be able to find out how large this economic moat is for this particular company. And Morningstar came out with very interesting articles that I read before with respect to economic moat. So I'm going to lay out a couple of points there. The economic moat can exist in various forms, and this term moat is brought about by Warren Buffett, and it shows how the company can manage its business without a lot of these competitors chipping away their market shares. So if you have a very large moat, then competitors cannot just come in and take away your shares. So let me give you a couple of examples related to economic moat. The first one is network effect. The good example about network effect is Visa and MasterCard, because they have huge payment network around the world. So I don't think that even if you have billions of dollars, you cannot just come and take away the market share. It's just not easy. You need to establish this kind of broad network in order for people to use your credit card. But if you don't have this large network, then people will not use your credit card. That's kind of the bottom line. And also you can think about Facebook and Uber. Once the company establishes very, very large network, other competitors cannot just come in and take away your market shares. It's going to be extremely hard because of this network effect. So this is one example of economic moat. And the second example that I can give to you is brand. Because Coca-Cola, Apple, Disney, Tiffany, all these companies are really great because of their brands. And another one is cost advantage. So if your company has large economy of scale, then you have a huge power in your industry and your business model is going to be protected by this economy of scale. And there are other things like patents and things like that. Maybe I'm going to make another episode down the road about economic moat, because this is a very interesting subject and also very important subject in terms of finding outstanding companies. So let's move on to the next one. So the next question that Philip Fisher is asking is, does the company have a short range or long range outlook in regard to profits? I think there should be the right balance between short-term profit and long-term profit, short-term aspect and long-term aspect. But I'm not particularly concerned about short-term outlook or short-term prospect of the company because that's what most companies focus on. If you dial into conference calls, a quarterly earnings call, what happens is that a lot of executives just talk about short-term things. And in many cases, they talk about long-term aspects of their company. But it's understandable that these executives focus on short-term profits and short-term outcomes because their neck is on the line. If they cannot make short-term profits, they might get fired like within 1 or 2 years. So look at what happened to GE. So GE was in trouble, and I think the former CEO name was John Flannery, and he came in and he got fired after 1 year. I thought that was not fair, but he still got fired because he was not able to produce short-term profits. So these executives are under enormous pressure to produce something in the short term. So a lot of these smart people focus on short-term profits. But what's lacking is that these executives do not put enough emphasis in the long term. But if you look at the stocks that have done tremendously well in the past, usually executives should focus on long term. Look at what happened to Amazon. Jeff Bezos, the first thing that he talks about is customer-centric model. So he focuses on customers and obsessively focus on customer. But the second point that he emphasized always is long-term aspect. He doesn't want to focus on short-term. He doesn't care whether the company is not making profit or anything like that in the short term, but he focused a lot on long-term. And a lot of investors bought into that idea, and now Amazon became huge, almost $1 trillion company. I think we are long-term shareholders. Value investors are long-term shareholders. We want a management team with an eye towards building long-term value rather than just managing for short-term results. While it is true that the long-term is made up of many short-terms, you also don't want companies to consistently forego value-enhancing projects or squeeze important suppliers and customers just because it might hurt quarterly EPS. Okay, so I think we discussed enough about this short-term and long-term, but the bottom line is that try to find companies that have the right balance. And since short-term profits and results are in focus by a lot of people, you better find also the companies that have a lot of focuses on long-term profits and results. Let's move on to the next point and next question. In the foreseeable future, will the growth of the company require sufficient equity financing so that the larger number of shares than outstanding will largely cancel the existing shareholders' benefit from this anticipated growth? Okay, you want to find companies that are financially healthy enough to fund their growth investments with internally generated cash or with reasonable amounts of debt. The way you can identify or the companies with sufficient cash is very easy. You can just look at the past cash flow statements and see if the company's past cash flows can meet all the dividend payouts, and also you have to look at the capital expenditure because that's the money the company reinvested back into the business, and see if there's still enough cash left over after capital expenditure and after dividend payout. And you can also take a look at share purchase. And a lot of US companies have great business model that generates tons of cash where they can meet all these requirements. If the cash is still left, then the company can use that cash in order to grow their business, or the company can pay out this cash to shareholders in various forms. So it's always good to know which businesses are good cash generators. So we have two more points. Let's just go over them one by one. The next one is, does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? It is the nature of business that in even the best run company, unexpected difficulties, profit squeezes, and unfavorable shifts in demand for their products will at times occur. Such disappointments are an inevitable part of even the most successful business. This is quite clear. I think good example is Warren Buffett and Berkshire Hathaway, because Warren Buffett talks freely about his mistakes in his annual letters all the time. And he provides both good news and bad news, not just good news. And he's not trying to hide some of the mistakes that he have made in the past. Okay, so another example is General Electric. The former CEO, Jeff Immelt, was a cheerleader for the company and shareholders. However, he didn't really want to report problems and difficulties to shareholders. And look at what happened today to GE stock. So that's a good example of what could go wrong. And, another example is Berkshire Hathaway that I just mentioned. That's something that you want to look for from management team. If management team is honest about their mistakes, then you're not going to have negative surprises in the future. But if management is trying to hide their mistakes or difficulties in their operations, you're going to have a huge negative surprise in your stock price in the future. So that's what you want to avoid. Last one, let's go to the last one. Does the company have a management of unquestionable integrity? The management of a company is always far closer to its assets than is the stockholder. Without breaking any laws, the number of ways in which those in control can benefit themselves and their families at the expense of the ordinary shareholder is almost infinite. So let me just give you some examples how the management team can benefit themselves at the expense of shareholders without breaking any laws. They can get paid so salaries far above the normal worth of the work performed. It's kind of interesting to see how executives get paid, but they are the one hiring these compensation consultants. And compensation consultants want to please the management team by recommending high salary. But yeah, there's just a lot of details we can discuss here within this space, but there's a conflict of interest inherently within this space for any organizations. And also executive teams have the power to sell or rent to the corporations at above market rates. If they have some real estate somewhere, they can try to get higher market rate by renting it to the corporations they're right now managing. And also they can buy subpar products and services from the companies they own individually. So insiders may have some private businesses and private companies selling some products and services related to the business they're managing. And they can do this kind of transactions between the company, the public company that they are managing, and the private company that they own personally. Then guess what's going to happen? The private company is going to sell the products and services at very, very high price, or the private companies, even if they are making subpar products, they can sell and increase revenue quite significantly. And that was kind of the problems that happened a lot in Korea, because I'm interested in Korean stocks these days. So you have to be mindful about this kind of practices and see if the management team is just serving themselves instead of stockholders. The last one is the abuse by insiders of their power of issuing common stock options. And this is kind of well known, so I'm not going to go into the details. If there's a serious question about the lack of strong management sense of trusteeship for stockholders, you should never seriously consider participating in such an enterprise. So what you can do in order to see if the management has good integrity is by looking at, as I mentioned, the proxy statement and see their executive compensation. You want to know whether they are getting paid while their performance was subpar. And if that's the case, then there's a serious trouble. The executive pay should be aligned with long-term performance. And it doesn't make sense to pay executive a lot while the performance is not doing well. But that's what happens in many cases. And I mentioned that executives are the ones hiring compensation consultant, forming this executive compensation committee. So they have a lot of say on how much they are getting paid. And consultants want to get hired again for the future business, and they want to please management team. And look at what happened. They recommend high pay even though performance is not good. So that's a fundamental problem that we are facing. But there are a lot of also executives who have the integrity to go against this kind of temptations and get paid fairly. And you should be very, very happy to see high salaries and high executive pay if they are doing well. And also try to see if you can find any negative news articles related to the executive team. And in many cases, you'll find some negative articles here and there and see how serious they are before you're making any decisions. And also, as I mentioned, check if controlling shareholders or executives have any private businesses and companies that transact with the company. Okay, we cover all 15 points about what you need to ask if you want to find outstanding companies in the market. So, as Philip Fisher mentioned in his book, you don't have to find companies that meet all of these 15 points. That's not the point. In some cases, some companies do not have to meet certain points brought up by Philip Fisher, but still can be outstanding companies. So there's a lot of qualitative things that you might have to do in order to find outstanding companies. But Philip Fisher just thinks that these 15 points are important. And at least you have to create some sort of checklist to see whether the company has any troubles or any outstanding aspects related to these points. One last thing that I want to mention is that if you just go over these 15 questions and points, then you'll realize that most of them are qualitative. When you actually try to find businesses, I think quantitative factors matter as well. But if you truly find outstanding companies, the qualitative factors are important as well. I think that's it for today's show. I hope you enjoyed this show. And before I end, I will just want to remind you that please leave your comments and feedback on whichever platform you listen to this podcast. I highly appreciate your support and see you next time.